Imagine this. December 1989. You are a 29-year-old salaried worker living in Tokyo. Your name is Kenji. You work at a mid-sized electronics distribution company in Minato. You earn 4.2 million yen a year, about $31,000. Your wife Aiko works part-time at a store in Shinjuku. Just now you did the most perfect thing a young Japanese couple could do. You bought an apartment in Saitama, 45 minutes by train from central Tokyo, a 2-bedroom apartment. The price was 40 million yen, roughly $290,000. You put down a 7 million yen down payment and took out a 35-year mortgage for the rest. Your monthly payment is 115,000 yen. It feels tough but manageable. Everyone you know is doing the same thing. Your father told you that land prices in Japan have never fallen, not even once, throughout the entire post-war period. This belief is called the land legend. It is not a theory. It is an unquestionable part of Japanese life, like cherry blossoms blooming in spring. On December 29, 1989, the Nikkei 225 index closed at 38,957, its all-time high. It is said that the land of the Imperial Palace in central Tokyo is worth more than all the real estate in the entire state of California. Golf club memberships are selling for hundreds of thousands of dollars. Major Japanese companies are buying the world's most prestigious investments. Japan is buying the world. Aiko asks Kenji whether they should have pushed for a bigger apartment. Prices are always rising. If they wait, they may never be able to afford it. Kenji says they made the right decision. The apartment will be worth more next year. It always is. Now let's see what happened. Not 34 months later, but 34 years later, the Nikkei would only return to the level it reached on the day Kenji signed his mortgage. Their apartment would be worth less than half of what they paid for it, and Kenji would still be making payments on a home whose value had remained far below his debt for decades. This is not the story of a currency collapse. Most economic collapses in history are directly related to inflation destroying savings. This story is the exact opposite. It tells what happens when prices fall, wages stagnate, and debt remains fixed. The system does not collapse. It simply holds you captive for decades. This is the story of Aiko and Kenji, and it is a deflation trap. Stay with me. The collapse shows itself in January 1990. The Nikkei falls almost instantly from 38,900 to 33,000 by March. By October, it is below 20,000, a 48% drop in 10 months. Kenji watches this from his office. His company's shares have lost value. His colleagues are tense, but he doesn't own any shares. He has an apartment, and apartments are different. Land prices had never fallen, until now. Tokyo residential land prices peaked in 1991 and then began to fall for 14 consecutive years, with not a single year of recovery. By 2004, land prices in Tokyo had lost about 65% from their peak. In commercial areas, the decline reached as high as 87%. The apartment Kenji bought for 40 million yen is worth 30 million in 1995. In 2000, it is worth 19 million. His mortgage debt is still 28 million. He owes far more than the apartment is worth. He is underwater and there is no way out. He cannot sell because he would realize the loss. He cannot default because it would destroy both his credit and his career. In Japan, bankruptcy carries a social stigma that Americans cannot even imagine. He is forced to keep paying. Every month, 115,000 yen is deducted from his account for an apartment worth less than his debt. The financial system breaks down gradually. In 1995 and 96, housing finance companies go bankrupt. Several large institutions collapse with trillions of yen in non-performing loans. The government injects hundreds of billions of yen. This is the first bailout. The public is furious. It will not be the last. In 1997, one of Japan's long-established financial institutions announces it is closing. The president tearfully apologizes to the public in front of the cameras. Thousands of employees lose their jobs. Around the same time, a major bank announces its bankruptcy. It is one of the most significant breaking points of the post-war era. In 1998, major credit banks go bankrupt and are taken over by the state. Towards the end of the 1990s, Japanese banks are carrying enormous amounts of bad loans. But the banks cannot foreclose. They cannot write off the losses. Instead, to avoid bankruptcy, they continue lending to companies that are already bankrupt. The Japanese call them zombie companies. Firms that are dead on paper but kept alive with constant credit. Estimates suggest that a very large and significant portion of Japanese companies in the 2000s are zombies. They absorb credit, suppress wages, stifle innovation, and keep the economy in suspended animation. What makes deflation different and more dangerous is this mechanism. In inflation, prices rise, wages follow, and paying off debt becomes easier because you repay a fixed debt with money that is worth less. Debtors win, savers lose. In deflation, everything works in reverse. Prices fall, wages stagnate or decline, but debt always remains fixed. Kenji's mortgage burden increases in real terms every month. In Japan, average wages peaked in 1997 and did not recover for decades. In later years, workers earned even less in real terms. For a long period, consumer prices either fell or stayed flat. A prolonged deflationary period occurred that is very rare in modern economies. The central bank cut interest rates to zero. It did not solve the problem. Companies and households stopped spending and borrowing. They focused on paying off the debts left over from the bubble era. Even with zero interest rates, no one wanted to borrow because the assets they bought would lose value. In deflation, rational behavior is to hold cash and pay down debt. When everyone does this, the economy shrinks even more. This is the deflation trap. It rewards the right behavior, saving, paying off debt, being cautious, but it punishes the behaviors that would save the economy. Spending, borrowing, investing. Individual rationality produces collective disaster. Japanese young people who graduated between the mid-1990s and the early 2000s entered a stagnant job market. Permanent jobs became as few as possible, while temporary and part-time jobs increased. Some completely withdrew from society. Their numbers were in the hundreds of thousands. Suicide rates rose significantly over the years, and economic pressure was one of the most important factors. This generation did not experience a dramatic collapse. They lived a future that slowly faded away. The survivors in deflation are, first, cash. In deflation, cash becomes more valuable every year. Japanese households kept large amounts of money at home. Second, government bonds. As interest rates fell, their value increased. Third, those who did not buy at the peak, renters came out ahead. Fourth, those who avoided debt. This turns everything you know upside down. The Nikkei, 225, only surpassed its 1989 peak in 2024, about 34 years later. Kenji's apartment remained below its purchase price for many years. Even after making payments for decades, it did not deliver the gain he expected. He suffered a significant overall economic loss. Aiko never asked about the bigger apartment again. This story tells us this: everyone prepares for inflation, but Japan showed the reality of deflation. The question is not, if the currency dies, what do you hold? The question is, in a world where everything falls, what do you do? The answer: cash. Those who hold both gold and cash win. Those who believe in only one think they know the future. Kenji's father was right for decades. Then he was wrong for a very long time. The question is, what happens when the thing that always rises stops rising? Subscribe, don't miss the next video.